Hello, everyone. Welcome. We are just letting everybody in. So just bear with us as before we start the session formally. And we have a very diverse panel today from different continents. And also, I think the participants are joining from different parts of the world. So looking forward to really hearing from you and knowing you from where you're joining and your interest in this particular topic and how you have participated in WAP's events and webinars. So as you can see, the count is going up. We're just letting everybody in. Thank you so much for joining us today. We are getting a lot of people who have been joining our events from the beginning of this series, Blended Finance and PPP series. So we really, really look forward to hearing from you on the sessions which we have presented before and how this session really adds to the discussion on this particular topic. All right. All right, so I think with that, we will start our session formally. All right, so good morning, good afternoon, and good evening to all our participants from around the world. On behalf of WAP, I'd like to welcome you to today's webinar, which is the role of public development banks and domestic financial institutions in blended finance PPPs. So this session is part of our ongoing 2025 theme, Mobilizing Blended Finance for PPPs, a critical area of focus for enabling sustainable and impactful PPPs. Actually, to start with, to open today's session and set the stage, I'm really pleased to introduce our president, Ziad Alexander Hayek, who will offer opening remarks and guide us into the discussion. Over to you, Ziad.
Thank you, Jyoti. Hello, everyone. Thank you for joining us for this important conversation. I want to take a moment to recap how we reached this webinar and where we stand in the blended finance for PPPs discussion. We brought a vision this year following last year's small-scale PPP program. What are the most beneficial and instrumental methods to bring the capital to where it's needed most? So blended finance is what we felt was the most important answer to addressing the issues of small-scale PPPs. But of course, blended finance applies to larger projects as well. So first, we have partnered with Convergence Blended Finance, which is a global network for blended finance. This partnership has flourished to more than just the webinars, and both of our organizations have benefited through the course of the past 9 months in elevating the need for blended finance structures for PPPs. Indeed, I mean, our program has relaunched a new discussion on blended finance in the PPP community around the world. Second, we charted a pathway to touch upon the most critical elements of what we need to fill the capital gap in developing countries. We started the program earlier this year with basics on blended finance. Then we examined both project and portfolio level blended finance structures, which brings not only commercial and philanthropy capital in the mix, but also institutional investors. We put local currency as one of the strongest levers to mobilize private capital, followed by the strong, impactful role played by the local governments. We published the guidelines on small-scale PPPs, I think it was in May, or June maybe, to underline these aspects, which I hope you have had a chance to read. And if not, please let us know. We're happy to send you a copy or a link to the small-scale PPP guidelines. Today's discussion will focus on critical yet often overlooked aspect of blended finance. It's the role of the national development banks and the domestic financial institutions in development financing and PPPs. National development banks collectively manage an estimated $20 trillion in assets, significantly surpassing the less than $3 trillion held by the multilateral development banks. So you can see the size is really huge. NDBs contribute approximately 10% of global annual investment from all public and private sources, underscoring their central role in development finance. A key differentiator is their dominance in local currency lending, which accounts for 81% of their total financing, outpacing private sector and multilateral institutions. This conversation comes at a crucial stage. Developing countries are navigating the intersecting demands of urban growth, climate resilience, and equitable access to public services. Yet the financing gap remains large. In the context of climate finance, NDBs already provide 1/5 of global climate finance, yet green assets comprise only 14% of their average credit portfolios, highlighting substantial room for growth. Of course, NDBs usually are involved with many areas other than PPPs, housing and many other things. And the idea that we want to talk about is how to get PPPs and infrastructure to be a greater part of their portfolio than it has been until now. The data we have illustrates the untapped potential of NDBs and domestic public financing institutions to scale up green investments and play a transformative role in financing climate resilient infrastructure, especially in emerging and developing economies. Today's session will highlight that with the right support, governments can unlock domestic capital and lead on infrastructure solutions tailored to their communities. We'll hear from 3 different public agencies and practitioners who publish this agenda, who are pushing this agenda forward. Through concrete examples and policy insights in places like Colombia, Uganda, India, and beyond, we will explore how governments can harness blended finance to deliver high-impact, resilient infrastructure, and what it will take to scale these efforts in the years ahead. So to guide us through today's session, I'm pleased to introduce our moderator, Jyoti Bisbee. Jyoti is one of the most seasoned infrastructure finance people I know, and she's a PPP advisor for more than 20 years at the World Bank and the UN. She joined WAP 4 years ago and has been a member of our executive committee, of our steering committee, and she's leading in the blended finance for PPPs program, which, she was also largely leading our small-scale PPP program last year. Jyoti, you're an inspiration. The floor is yours.
Thank you, Ziad. Thank you for that. That was a lovely opening. And I actually forgot to introduce you. So I know my colleague Aisha is posting all our bios because it's really difficult. I mean, all the speakers here are so accomplished and experienced. It's really hard to, collapse all the experience in just few sentences and words. But just to tell you, Ziad is our president and vice chair of the Working Party on PPP of the United Nations Economic Commission for Europe and High Commissioner of the World Business.
Let's move on to the important, interesting things. Yes.
Okay. All right. So really, I think it has been a interesting series, I want to say, and this particular webinar just adds to the discussion we've had so far in the past 9 months. So the agenda for today. So we will begin with an overview by Convergence. Akif Merchant, who is here with us, he will offer an overview of blended finance activities and key market trends from national level banks and financial institutions. Next, we will hear from Rosemary Yong from Asian Development Bank on how an MDB interacts with national financial institutions to leverage development financing. And then we move on to an expert panel of representatives from 3 different continents. And this is really exciting for us. Latin America, we have Enrique from Colombia. Africa, we have Francis from Uganda. And Asia, we have Kishore from India, to showcase their national institutional models to attract and catalyze blended financing from the markets. And this will be followed by an audience Q&A. But that shouldn't restrict the audience to interact with the speakers and with each other. And that's how we learn more. So just a few housekeeping points. Please introduce yourself in the chat with your name, organization, and country. And you're also welcome to share your LinkedIn profile and connect with other audience, and keep the chat interactive. If you have a question for the panelists, please put it in the Q&A box because otherwise it becomes really difficult. And my colleague Aisha is here to help with presenting the bios and any other links which we have presented in small-scale PPP guidelines in the chat. So let's move with our first speaker, which is Akif Merchant. He is a Director of Engagement and Capacity Building and Head of Africa at Convergence. Akif collaborates with governments, development financial institutions, and investors to scale blended finance solutions around the world. He brings hands-on experience across Africa, Asia, and Latin America. He's a leading voice in embedding blended finance into both policy and practice. So welcome, Akif. Would you give us an overview of the role of domestic development banks and financial institutions in the blended finance landscape? Over to you.
Great, thanks, Jyoti and Aisha and Ziad. It's been a great partnership with WAP, and I appreciate being invited again to attend and speak at one of your webinars. Good afternoon, everyone from Kigali in Rwanda. So I'm going to talk a little bit about the role of development finance institutions or national development finance institutions and financial institutions insofar as the blended finance ecosystem is concerned. And then I'll leave it to Francis, Enrique, and Kishore to actually bring some of that back down to a PPP lens. I think it's helpful to start. I know some of you follow these webinars over the series, but I think it's helpful to start with, again, the first principles definition of blended finance. So what is blended finance? Blended finance is a financial structuring approach. It is the use of development funding from public and or philanthropic agencies or organizations on catalytic terms, on concessional terms, with the expressed intent and purpose of mobilizing private capital that's sitting on the sidelines into transactions, geographies, and sectors that we all care about, and we want to see more of that private capital flowing towards. Now, when it comes to development banks, we've got around 80 odd development banks, believe it or not, national development banks in Africa. They're all part of the African Association of Development Finance Institutions. We've got a similar association or group called ADFIAP in the Asia Pacific. But these are 80 odd organizations across the continent. And what do? They are uniquely positioned to originate and arrange transactions as part of being a national level development bank that is aligned to their respective countries' development mandates. So Francis's development bank, the Uganda Development Bank, is very much aligned to Uganda's third national development plan. Here, my partner, the Rwanda Development Bank, is very much aligned with the Rwanda's national 2050 vision. It's really important to underscore that these development banks are oftentimes the partner of choice for donor agencies and for concessional providers of capital. Concessional capital is really important in this entire equation of blended finance, like I defined earlier. And so these development banks are the natural partner of choice. Oftentimes, these banks use this concessional capital to blend it with their own account and push money out of the door to reduce the cost of capital of a specific transaction. Or they use that specific pot of money that they've been provided with to catalyze and mobilize private sector capital in a specific transaction. I'll give you a couple of examples. Here in Rwanda, with the Rwanda Development Bank, we have a program called Ireme Invest, where the Swedish government with their guarantee program, AFD from France, FCDO from the UK, and others have all provided the Rwandan Development Bank with some capital to blend with their own account and then push money out of the door on a lower cost of capital to various different green financial initiatives across the country. The Gates Foundation partners with the Tanzania Agricultural Development Bank to build agri-value chains across Tanzania. The Ghanaian government has provided the Ghana Infrastructure Investment Fund $345 million of concessional money to actually act as a de-risking entity to various different infrastructure projects in Ghana. KfW Development Bank from Germany provides lines of credits to a range of different development banks across the continent, including, for example, IDC from South Africa, that again blends this with its own account and pushes money out of the door. So that's often typically how development banks partner with concessional providers of capital to reduce the cost of capital of transactions or mobilize private sector capital. Jyoti, you asked me some of the sectors in which we see the highest amount of activity from these banks. It's typically infrastructure, the renewable energy sector, SME financing, and agriculture. And a quick side note on domestic financial institutions. These are the equity banks of the world, the NMB banks of the world, the standard banks of the world. There are two ways in which I typically see these banks operate in the blended finance ecosystem. Oftentimes, national DFIs from the global north, like Norfund or British International Invest or FMO, these organizations actively own a stake in some of these national development banks on the continent. So therefore, they influence them to do things they wouldn't do otherwise with their lower cost of capital. But another way in which the domestic financial institutions are active is oftentimes they partner with very many guarantee organizations or guarantee agencies who provide them with a portfolio guarantee and tell them, look, we need you to lend to a green infrastructure. We need you to lend to gender SMEs. And if you do lend to these asset classes, that there is a difference between the perception and the reality of risk, we will then provide you a portfolio first loss cover of around 50 or 60% of the total loan book. And oftentimes it also give them an origination incentive. So that's typically how I see financial institutions as well participating in this particular space. So I'll stop here. Hopefully this just sets the context a little bit for what's to come. And I will yield back the balance of my time to you, Jyoti.
Akif, you still have 2 more minutes. I wanted to just see if you can expand on, you mentioned both concessional and commercial capital going through a national development banks, right? So can you expand a little bit more on the commercial capital, how that can be used? I mean, national development banks can be used as a conduit?
Yeah, so typically, if you look at a national development bank, what are the different forms of financing? Number one is its main whole and sole shareholder is typically a national government. So that would be the government of Rwanda, the government of Uganda, and others. Then the second pool of capital would be these concessional partners, or what they call donor partners. But we have seen when it comes to the Trade and Development Bank, for example, it's slightly broader than national development banks, but these are, let's call them regional MDBs or regional DFIs. So the Trade and Development Bank or DBSA or BOAD from West Africa, these regional development banks have opened up their shareholding book to institutional investors and to more traditional commercial capital providers like insurance companies and others who are partnering with them to essentially expand their offerings. So typically you'll see donor countries, you'll see national governments, and then you'll see the third form of capital, which is commercial capital, typically long-term commercial capital from institutional providers who partner with these development banks. And that's typically in the form of regional development banks, not at the national level.
All right, thank you, Akif. I think you've actually put a lot of thought for process on the table. So it'll be interesting to hear from our panelists. So let's move on to Rosemary Young from Asian Development Bank. Rosemary is a principal market development advisory specialist at the Office of Market Development and PPPs. Rosemary is a seasoned PPP transactor, having worked in ADB, PwC, and investment banking, with extensive experience in advising on PPP transactions across various sectors, including transport, logistics, water, healthcare, education, and social infrastructure. Rosemary has a proven track record in delivering high-impact advisory services. Welcome, Rosemary. So Rosemary, would you share with us your perspective of the role of national development banks in domestic FIs? And I know you have a great example to share with us. So over to you, Rosemary.
Sure. Thank you very much, and good morning, good afternoon, wherever you are. So I'm Rosemary. I am based at the headquarters of Asian Development Bank. And I'm here to share with you some of our perspectives in terms of strategic use of concessional donor resources, including ADB's capital and mobilizing infrastructure investment in projects with high development impact, and the role of MDBs and blended finance in de-risking infrastructure PPPs. So I think I have, okay, thank you. Next, please. Next. Right, thank you. So in terms of the definition and role, I think Akif mentioned some of the key features of blended finance, and particularly for MDBs, it is really combining concessional financing as well as our developing technical assistance programs and guarantees in order, as well as from public philanthropic sources, in order to help de-risk certain projects. Now, why does it matter for PPPs? As you all know, many projects in Asia face viability and bankability challenges, especially in emerging markets with higher risk profiles and those that are non-investment grade markets. Now, these issues include foreign currency and political risk, demand and revenue uncertainty, especially for greenfield projects, high upfront capital with long payback periods, and limited government fiscal space for guarantees or subsidies. Blended finance shares the risks between private and public parties, making the projects more financeable. Next, please. So ADB does offer a range of financing instruments emanating from concessional loans to reduce financing costs. We also have guarantees from our private sector operations department covering payment and political risks. And also from the sovereign side. And then we have viability gap financing structures in order to alleviate any viability risks, and equity co-investments and thematic climate funds. So our use of blended financing in PPPs deploys blended finance instruments through our own balance sheet, as well as concessional funds and donor funds that are entrusted to ADB through trust funds. Now, for viability gap financing or funding, this is actually quite common and prominent in Asia. Now, there are a few examples where this is in practice. Renewable energy IPPs, where we have concessional loans and guarantees. In Cambodia, for example, the ADB sovereign loan was used to finance the transmission lines for the solar farm that was being built. Now, over to transport, in the Philippines, the ADB has financed through a sovereign loan facility to the Philippine government the rail infrastructure. JICA from Japan has financed rolling stock, and the private sector will be providing O&M and some pre-operating costs. Now, in order to de-risk the project, since this is a greenfield line that spans about 147 kilometers, linking the northern part of Luzon province in the Philippines through to Clark. Now, there is a viability funding gap or an AP structure that's being put in place. Next, please. So I will be talking through some of the examples, specifically in a recent example of asset monetization, which is another subset of PPPs, effectively asset monetization by concessioning out an operating asset that has a long history or that is a brownfield asset, so that the government would be able to recycle any upfront payments or any of the monies received for other infrastructure or future infrastructure needs. Now, we call it either asset monetization or asset recycling, but the basic principle is that governments are able to extract value and monetize from a operating asset and utilize the cash that has been received to fund other infrastructure needs. Now, the case study that I will be sharing with you has been a successful project that I have led, that ADB has advised on in the Philippines, and this is the Ninoy Aquino International Airport, which is the premier gateway in the Philippines. Next slide, please. So ADB's role was the transaction advisor to the Department of Transportation in the Philippines. Now, our advice spanned or tried to meet the objective of government to expand, modernize, and rehabilitate an aging asset. Now, this is an airport that has been organically developed over the span of 60 years in the Philippines. So you have non-contiguous or not physically connected passenger terminals. You also have an infrastructure or an airport which is right smack in the middle of the city without any room for building another runway for expansion. So the ADB team worked, sorry, excuse me, worked tirelessly to first do the usual due diligence and intimately understand and get acquainted with the asset. So we figured that there was growth left on Ninoy Aquino International Airport or the Manila Airport. We also helped the government develop their national airport gateways, national capital region airport gateway strategy, which allowed a multi-gateway system throughout the Luzon province in the Philippines. The key structuring points of this were that the Philippine government was able to monetize more than 650, approximately $650 million upfront, about $34 million every year for the next 15 plus 10-year concession period, and a revenue share of 82% of all the revenue streams in the airport, excluding the passenger service charge. Now, the development impact is such that the project was able to provide um, to provide a modern and able to mobilize about $2 billion in private capital for the initial for the initial modernization program of the airport. Now, in terms of scope, this was the most comprehensive airport PPP in the Philippines, if not Southeast Asia region, where the government of the Philippines concessioned out the operation and maintenance of the airside facilities, including the runway apron facilities, as well as the landside with all 4 terminal buildings. ADB has provided a holistic approach whereby we had a robust transaction advice to maximize the value for the Philippine government. It also provided some social safeguards and incorporated climate change and adaptation measures, including encouraging the use of sustainable aviation fuel and also mandating that 20% of the energy needs by the airport will be from renewable sources and mandating flood control measures for climate adaptation. Next slide, please. The transaction highlights represents a unique opportunity for the government to tap into unrealized potential of NAIA. So not only was the government able to mobilize about $2 billion in capital for the much needed capital expenditure for the airport, as the airport has gone through decades of underinvestment by the Philippine government. So it was time for the airport, not only for the terminals to be spruced up for better passenger experience, but for the airport to actually be more efficient, including passenger, all the passenger or flight information systems through to passenger experience type improvements, such as passenger lounges and the check-in counters, as well as the luggage belts. Now, the transaction also optimized and improved the performance of the airport, increasing runway capacity from its current 42 movements per hour to 48 air traffic movements per hour. And this basically just expands or provides a capacity expansion for the runway, and this will allow through the transaction. It also allows the concessionaire to maximize the capacity of the airport by ensuring that the airport will be able to service about 62 million passengers per annum. So by the time we concessioned out the airport, or the transaction was closed last year in September last year, was actually the handover. So this month marks the first anniversary of handover. The airport was already processing approximately 50 million passengers per annum. The core
You
objective
have
was,
30 seconds, Rosemary.
okay. The core objective was to develop the commercial and the potential of the airport to enhance receipts for government. Last slide, please. So the last slide, this just demonstrates to you how much the government of the Philippines has gained from this transaction, from the 30 billion pesos, which is approximately $650 million at the time of bid, as well as annuity payments paid every year, and an 82% revenue share. Thank you very much.
Thank you, Rosemary. So just to have a follow-up question, what was the role of the National Development Bank or the domestic financial institution in this deal? I think this is a great example. Asset monetization, asset recycling has really become the buzzword nowadays in developing economies. And there's a question, was NAIA guaranteed by the government or
Nope.
on projected cash flows?
NAIA was not government guaranteed. Zero guarantee from the government. And to your point, Joyty, in terms of what was the role of the National Development Bank, the Development Bank of the Philippines was one of the lenders. It was it was an oversubscribed, fully locally closed transaction, right? So all the lenders were local banks in the Philippines, including the Development Bank of the Philippines.
All right, that's great. I think this is really, I mean, this is so much to unpack, Rosemary. Unfortunately, we need to move on, but please feel free to reach out to Rosemary for additional questions. I see the chat is really coming alive on this presentation. So let's move on to our panel discussion. And we have three great panelists and bringing unique expertise and experience to our discussion. And we are going to start with Francis, who's a chief economist and director of economic research and knowledge development, management in Uganda Development Bank Limited. Before joining Uganda Development Bank, Francis worked as a senior research fellow at the Economic Policy Research Center, Makerere University. He is also a global fellow at Peace Research Institute in Oslo, and has consulted for several organizations, including the World Bank, FAO, and UN Women. So Francis is also has worked for Ernst & Young. Next, we welcome Kishore, who is an economist and corporate finance professional with 25 years of experience in finance, banking, credit, project management, HR, and legal affairs. He holds a PhD in finance, is an associate company secretary, and has postgraduate degrees in commerce management law. Kishore is joining us from India. And last, from yet another continent, we are joined by Enrique. Excellent panel, really. With over 30 years of experience, Enrique is currently serving as a vice president of structured finance at FDN, which is Financiera de Desarrollo Nacional. Exactly. I'm trying to make my pronunciations. Where he oversees infrastructure project financing and the capital markets division. Enrique is an industrial engineer from the Universidad Industrial de Santander with additional studies in international business and investment banking at New York University and corporate finance at Tecnológico de Monterrey. Let's now begin our roundtable discussion. So there will be two rounds of questions. First round will focus on project preparation and second on project financing. So then we'll open the floor to the audience. So please keep posting it and please feel free to answer each other's questions on the chat as well, because we have a lot of experts in the audience. And definitely, please, each speaker will build on the previous remarks, especially what we heard from Akif and Rosemary. So I think one of the hardest challenges identified by both project owners and capital providers is a lack of an investable pipeline of projects. We have heard this over and over again from Convergence Blended Finance, from Chris Clubb, its managing director. So this is a direct result of lack of proper project identification and preparation. So let's start with Francis. Francis, from the African perspective, can you briefly introduce Uganda Development Bank? Are there specific project preparation and structuring models where it's proving most effective? And what lessons can be drawn from Uganda for scaling these approaches across the African continent? Over to you. You have 5 minutes.
Thank you, Jyoti. Uganda Development Bank is a national DFI or development finance institution. Actually, it's the only national development bank. It is fully owned by the government of Uganda and reports directly to the Ministry of Finance, who are the key shareholders. Uganda Development Bank's role is to catalyze private sector growth through financial and non-financial interventions. The key word here is catalyzing, really. And that's where really what you speak to, structuring, generating quality pipeline comes in. So it is to catalyze private sector development through financial interventions. The two key financial interventions are debt and equity, and the non-financial interventions are project preparation, business advisory, because again, UDB, or we support a range of products from SMEs to real large infrastructure projects. We have a climate finance facility that targets green investments and talk of infrastructure projects in the space of energy, renewable energy, waste management, and many other green-related projects. So broadly, that's the role of Uganda Development Bank. What role do we play in project structuring at feasibility? I'll speak to the process. Definitely not all projects go through this process because it's not a one-size-fits-all, but it really speaks to what we do consider and what informs project structuring and project preparation. As I said, the bank implements national development plans. So we kind of know which projects, programs require investment. And now our role is more important with the shrinking fiscal space following COVID and increasing debt burdens. We see many countries turning to national development banks. And so it is with Uganda Development Bank. We see government reaching out saying, can you mobilize funding for such big projects? And so what we do as a starting point is to rationalize. There are always many infrastructure projects that you can implement, and you do not have resources probably to implement all of them at a go. By sector, we pick projects, and we work closely with the responsible national agencies. So you really start, for example, I'll speak to a few that we are working on right now. We are working on one in waste management, and this is targeting waste management in major cities. And we are working with Kampala Capital City Authority. It is a good starting point because a project might never be feasible if you do not have strong buy-in of the responsible authorities, of the government ministries, because beyond financial constraints, there are regulatory and other policy-related constraints that you want to unlock before investing in, or even before you invest in structuring and preparing that project. And so what we do is our starting point is the responsible ministry. Get to know, and then after engaging different ministries, agencies and departments, and identifying the key infrastructure projects, we rationalize depending on the need, depending on urgency, and also what research tells us, again, on the need. Then after that, and after securing their buy-in, at that point, we identify the key gaps, could be regulatory gaps. One case in point is recently we're supporting to structure an energy project. That energy project, we realized it could not work unless a clause would, in the energy policy would be changed. We call it deemed energy clause, which basically says that the government will not pay for energy that is not utilized. So if you get an independent power producer that wants to invest in this, and they are not assured of pay unless that energy is off-taken, then they cannot put in their money. And so we had first to engage the ministry and secure buy-in and make sure that there is we amend that clause. Now, once you unlock that key policy and regulatory constraint, as a bank, now we come in with project preparation. We put in our money because at that stage, not many even private players are willing to fund project preparation activities. And we put in our money, but again, our view is we get to capitalize that money. Once the project becomes bankable and feasible, we capitalize it. If we are putting in equity, it will be capitalized and we recover it as part of the equity injection. If it's debt, we also capitalize it and get to recover it as a debt, get to recover it as they repay their debt. And that's how we do it. So we again gauge how much is needed for project preparation. We put in that money for project preparation as a bank. Now, at that stage, for some projects, we actually engage MDBs, other MDBs, and we have quite a number of them that we are working with, who would say that for energy, we're interested in energy, and we are happy to put a fund and put in 50% of project preparation money, and UDB brings 50% of project preparation. And we'll eventually get to capitalize. The beauty with that is you get to source concessional, very cheap money for that role. Some of these, it could even be a grant. It's an enabler, and that's a viability sort of gap funding that they put in. So we get that money fund project preparation. We do feasibility, pre-feasibility, feasibility studies, and so forth, again, depending on the project. After that, we do financial structuring, again, to make sure that whoever puts in money gets recovered. At that point, we have not sold this project to any potential investors. But what we are doing at that point, we are engaging other MDBs and other partners who are interested in specific projects. I'll give an example. For power generation, the 3 projects we are structuring right now, we are working with Africa 50. This is another funder, and they're interested in energy projects. So we engage them, they support with funding project preparation, and then we start even engaging and talking about the funding mechanisms, who puts what. At project preparation, we ascertain the size of these projects. We get to know who will put what. UDB would commit on what they would put in, either in form, again, depending on our assessment, whether we need to put in equity or it's bankable enough and it can attract debt. We also determine how much we need to put in as debt. And then we see how much to crowd in, either from other financial institutions, local financial institutions, or other MDBs and other development partners that we do engage. Then after that, we re-roll out the project. Sometimes you find that the financial needs are so huge that even if you syndicate, because there are projects where we syndicate as UDB with other local financial institutions, and you still find there is a gap. Now we have an option of going to the capital markets to raise more money. And so that's basically how we do it. And of course, in the process, we work hand in hand. Partnership is key all the way from government buy-in and the engagement to other MDAs and partners, and then the private sector coming in. Now, private sector comes in as funders, but also as implementers, because you want also to attract and crowd in the right implementer. And so that's basically how we do it, and that's how the process is. It varies by project, depending on the scope on financial needs and the risk. But broadly, that's how we do the project preparation and structuring, working hand in hand with other responsible partners. Yeah,
thank you, Francis. I think you've made so many different points. It's I was like listening to each and every word you just said. Just for the audience understanding, how long did UDB take to reach this point? Because obviously I can hear that you've actually really have made advancement in terms of project preparation and structuring.
It's been a journey, and thank you for asking this. It's been a journey, and I think it's targeted to our strategy cycles. Like what I'm speaking to now, we are doing it during this current strategic strategy. We've interacted closely with AKIF and Convergency, and our strategy is, we call it supply-driven program-based financing. So originally, where we started, it was more of, again, we called it demand capture. just like any other financial institution, a business reaches out, we want financing, you appraise, you do credit appraisal, it's bankable, you give them money. But then we realized that that approach was not helping us address the key constraints in the economy. There are sectors that you will never get a private player signal their interest to invest in. And so with that realization, and of course the growing need from government, we started attempting or channeling to what we call program-based financing. And that's basically in our new strategy, it's what we do. We call it demand generation, program-based financing. You start by identifying a need and engage key players. And of course, it's always a back and forth, Kaizen of some sort. It's learning by doing. So you start, you skip a player, you structure it well, you think it's bankable, you don't attract funding. And then you realize it's because you never interacted enough to address. Sometimes we think that the de-risking is mainly in terms of the financial de-risking instruments of guarantees, of insurance, of even putting in this project preparation money. But we've got to realize that some of the risks go beyond financial related risks, like to the regulatory and policy environment that I talked about. It happens to be one of the key impediments. So it's been a back and forth and it's been a journey. UDB started operating in 1972. And all this that I'm talking about is not more than 10 years, if I can. And so it's a very recent development, which is real working, but also collaborations. Jot, I shouldn't forget this. We have an MOU, for example, with Convergence, and we work closely with other MDBs. Talking of the big, maybe I can mention a few like European Investment Bank, African Development Bank, IFD, and other partners that we do work with. There's a lot of cross-learning, and even when we are supporting with project structuring and conducting sort of hand-holding, we work closely with these partners. So we are not doing it alone. We work, again, with these able partners that help us deliver this.
Thank you so much, Francis. I think you've really captured the essence of success. And it doesn't take 1 day, 2 days, or even 1 year. It's really a long-term process, but also the need for partnerships in terms of external and both internal, right? And really a full holistic picture from regulation to financing to fundamentals of the project itself. And I think that really brings us to a very good point to Enrique. FDN has been, I think, has seen a similar journey as UDB. And so Enrique, why don't you really walk us through this journey which FDN has taken? I think it's one of the most successful development banks we have seen, and really all the points which Francis sent. So over to you, Enrique, waiting to hear all the things which you have to share with us.
Well, thank you for the invitation. And first we'd like to explain who is FDN, Financiera de Desarrollo Nacional, which is basically a national development bank. We are focusing on financing infrastructure and develop and trying to structure projects, road, port, airports, everything that is called infrastructure is passed through our table. We finance directly to the project, which is different with other national development banks that we have here in Colombia. We participate really directly in the financing and the structure of the projects. And we have two different areas. One is helping the government to structure teams, to structure projects, and to put projects in the market. And the other team is focusing on financing and helping to finance those projects. So those two teams are the main push forward projects that we have here internally in our institutions. Now, in order to do that, trying to focus on the first step, which is the power preparation projects, which is one of the main restrictions that we have, and I think I'm fully agree with our previous explanation about all the path that we have to go through in order to have bankable projects. So the first restriction that we see on that part is the lack of well-structured projects that we can put on the market. And in order to do that, we need to help the government to structure in the way that is attractive to investors, that brings not only potential investors to the table, but also commercial bank, development bank, and all kind of institutions that make feasible the project. We see a success project when you see a project that is liquid, that you see potential investors in the whole cycle of life of the projects, and also financial institutions, capital markets in the market. For us, it's very important to see that, and that's what we call successful project, when we see a liquid market in the whole circle of the projects. Now, it sounds very nice, but when you start to look at the details, it has a lot of challenges in this. The first part is when you're talking with the regional cities or the department, which is basically states here in Colombia. One of the main restrictions they have is the lack of resources. So in that part, we need these power preparation facilities, so can help in terms of costs to make this structure process feasible for this institution, because the cost and the time on that is sometimes more expensive than they can pay for it. So those resources, the grants and power preparation facilities are very important in this part of the process. And we have basically a very close conversation with the World Bank, with the BID, and all these national development, all the development banks, in order to provide those resources to those institutions. But also we have like vehicles that we can collect that money, and we can help the regional cities and things like that to help those to structure the teams. This is a very important part of the process, because the way we structure and the quality of the structure make the first step of make a bankable the project, make a liquid market on the process, and that's the main restriction. And this is, but not only the restriction is a matter of cost, but also sometimes is to have to prepare the government to have discussions like regulation that need to be changed, adjustments in terms of rules, or maybe some of the institutions. We have some experience in renewable projects that the market wasn't prepared to receive interruptible energy. So we need to prepare our technical team in the government that handle all the interconnection system, so they can be sure that they have the appropriate rules so they can handle interruptible energy. And those first stages was paid by international institutions like World Bank and IDB. So they help to increase the capacities of those institutions so they can handle interruptible energy. Just to give you an example, the kind of things that we need to do in order to make these projects bankable. So in general, just focusing on the first part, which is a power preparation facilities, is very important for us to help to reduce the cost to structure those projects, but also to prepare or increase the capacities of the government and the government institutions, so they can handle different approach, or they need to change some regulations so they can have international standards compared with other countries, so we can bring international investors. That's maybe the main to focus on this part of the process in the project preparation of infrastructure.
Thank you, Enrique. I think, again, a different model. I hope everybody can hear me. I had to change my my headphones. So I different model than slightly different than UDB, and I think I hope the audience is able to is really able to capture the differences, the nuances, which we are beginning to see in the modalities, and they all work. It also depends on the context and the way the countries are set up. Have set up these development banks. And I think for a third perspective, we now go to Kishore. We do have some questions already in the chat and in the Q&A box. So please, panelists, feel free to answer them directly in the chat. So moving to Kishore. Kishore, your perspective from India is extremely important, because India, just like Philippines, which Rosemary shared, Enrique shared from Colombia, it's a slightly more advanced market in terms of its domestic financial institution capital markets. How do you see what has worked in India in terms of sectors, It has active domestic public banks catalyzing development for infrastructure projects in the country. So can you give us your top 3 takeaways on how India has developed an active market? Over to you.
Thank you, Jyoti. I'll not count the takeaways, but yes, I'll share a few details. Firstly, being a developing economy, India has always been short of infra for decades. And as we all know, infra requires huge risk capital and has long gestation and involves mediocre returns, not very attractive returns like information technology sector, etc. But the positive angle is any group which wants to grow has to have presence only in infra, because this is a big boys game, big volume game. And therefore, the big ticket projects can be taken up in this. It has stable returns and long-term returns. These are the attractions for any big player to get into infrastructure sector. Now, to give a perspective, infra used to contribute about less than 1% to GDP of India. Now it is 3.5 and expected to touch close to 8 and above in the days to come. That's the importance of infra which has been playing in the Indian development history or the story. Now, until 30 years back, PPP as a concept was new to India. It was not heard. Maybe it was in some very makeshift adjustment model, but it was not in a standardized or appreciable model. It started in a small way in about the mid 2000s, etc. But in 2011, a while before 2000s, 2020s, the guidelines and the model and also to attract the intending private players into the public-private partnership concepts and the projects. That has been a game changer in India. And since then, it became a standard model. Last 20 years, more than $1.4 trillion is spent on PPP projects in India. As you rightly said, India is among the leading top 1, 2, or maybe 1, 2, 3 in PPP markets, PPP projects. The CAGR, the compounded annual growth rate, has been more than 10% and is expected to remain or increase further in the days to come. The growth is possible due to the national development banks, which our other learned speakers have slightly touched upon, of course, touched upon in detail. But the interesting aspect as far as Indian NDBs is concerned is they're termed as development financial institutions in India. Maybe elsewhere also they are termed so. Between 1960 to 1980 or so, we have seen good number of NDBs playing an active role in India, being formed, etc. They're active for about 40 years, and the names are known globally also, including IFCI, IDBA, ICICI, IDFC, SIDBI, etc. But by 1995 and after, they all became very less active. Few became dormant, few got into huge non-performing loans situation and almost were on the verge of extinction. Couple of them, rather 3 of them, the most popular and leading NDBs, namely ICICI, IDBI, and IDFC, they have transformed into full-fledged commercial banks, which are called universal commercial banks. Others also tried, but they could not succeed. That was a sad story of NDBs at the time. But subsequently, these NDBs, the requirement of these NDBs was realized, and there was a revival. Few NDBs were formed anew. For instance, NABFID, National Bank for Financing Infrastructure Development, and IIFCL. These two are the new age DFIs, the NDBs in India. And these two are closely working with the World Bank, ADB, and other multilateral development banks, and many other international agencies as well. Cumulatively, these two would have lent about $50 billion worth of funds in the last 15 years or so. Therefore, NDB journey per se suffered some negligence, and with the realization of their requirement and the need for long-term capital, commercial banks having their own limitations in funding such a kind of long-term requirements or having the risk concern, etc., NDBs were revived in India, and a couple of more are also in the pipeline as per the policy discussions. And these now have been playing a massive role
in supporting the PPP projects in India. Now, not only these supporting the big projects, these NDBs are acting as super banks for the commercial banks, wherever commercial banks are taking exposure. In fact, President spoke a very important point about takeaway financing for the PPP projects because they have a very long gestation. The takeaway financing has become very active in India of late during the past 5 years, which was just a theory point or a record point in the theory, and now is playing a very active role. Banks have found liquidity possibility in PPP projects thanks to takeaway financing, which is called in multiple names. And in India, there is Secondary Loan Market Association, which is getting more active. Because of that, even commercial banks are also playing important role, supplementing, if not supplanting, supplementing and assisting the big boys role of the NDBs. On the example of any state, not one, there are many states in fact, Maharashtra, Madhya Pradesh, Karnataka, Gujarat, Uttar Pradesh, Andhra Pradesh, Telangana, etc. All of them have been playing a big role in promoting PPP projects in India. Maharashtra per se is leading with about 1,200 projects and 10 billion volume. Madhya Pradesh about 800 projects with 4 billion. Karnataka and Telangana, Andhra more or less similar. Gujarat and UP, Uttar Pradesh are slightly ahead of other states in terms of volumes and number of projects. By the way, the place where I am, Hyderabad, has the world's largest public-private partnership metro rail, which is most successful project in the PPP history of India in terms of operational benefits and in terms of giving the required economic multiplier effect to the public at large. Maybe it has not seen the break-even point because of the intermediate disturbance due to Corona for about 1.5 to 2 years. Keeping that period aside, this is one of the most successful projects in the world in PPP sector.
Thank you, Kishore. I think you brought a very important point. Actually, you brought many important points, and due to limitation of time, I don't think we can go into every issue, but non-performing projects and loans, I think it's a big issue, and I'm sure Enrique and Francis and Rosemary and Nakif will have a lot to say. And actually, I want to connect this issue for my next question. Going to Francis, it is actually along the same lines, right? The creditworthiness of the counterpart, Francis. And Kishore mentioned, I mean, it's the volume game, right? So at some point, I mean, I know UDB has a comparatively shorter lifetime than FDN and some of the state banks in India. But I mean, how are you really capturing this in your financial instruments and your government backing? In a way, it's capitalized by your fiscal, by the sovereign, and then eventually, how are you managing that with the project itself? So over to you, and let's just take 2 minutes each for each speaker, very quick response, so that we can take some questions from the audience. Thank you. Over to you, Francis.
Thank you, Jyoti. I think that's a real important point. It's important to recognize that for national development banks to be able to raise concessional funding, to raise the necessary, the funding we require, there are huge funding needs, you have to first clean your house, if I may use that term. So the governance must be robust. There is no way an institution, an MDB or any other institution, we are in the green space. We are engaging, for example, Green Climate Fund, Adaptation Fund, and other UN climate funds. For these institutions to have trust in you and give you these huge amounts of money, you must be doing well internally. And so that's one of the key areas we focused on as a bank. Definitely as a DFI, we belong, actually our MD, our managing director, is currently the chair of ADFI, Association of African Development Finance Institutions. And as ADFI, they came up with a threshold, an NPL threshold of 15% for DFIs. Of course, many commercial banks, their NPLs, I think threshold is 5%, but we appreciate that we deal in a risk management, we support risk sectors, including SMEs, agriculture, and so forth. So as ADFI, they agreed that you have to not exceed 15%. And UDB consistently has been below that 15% as NPLs. And now NPLs or credit, the quality of your portfolio is dependent on a number of factors. It is how you structure a project. It should be clear that the way you structure a project, if you overlook some of the key areas that are so crucial to the success of the project, that project will not perform. You will mobilize resources if you're lucky. You will deploy those resources, but you will not be able to recover. And now failure to recover because infrastructure projects and these projects that we are talking about here are huge. Heavy ticket-sized projects. Just losing one or two projects can have far significant implications on your portfolio, on your NPL, and your ability to raise more money. So that's why, and I saw a question here, I could link it to this submission. Why do we invest? What motivates us to invest in project preparation? It is because we want to make sure that we are in control of, not in control, of course, we will not manage it eventually, but we know in and out and the entire ecosystem of this project, and we are sure that that project will succeed. So that by the time we raise and deploy money, we are able to recover and get to repay, investors recover, MDBs recover, and then we get to build. And that's how you gradually build even your size as an institution. And now, because of that, we are rated by Fitch, because rating is key, and we are a AAA rated institution, national rating. I want to make it clear, because as a DFI, we go by the sovereign rating.
Yes.
And so we will not exceed our sovereign rating. But for national rating within Uganda, we are AAA rated, and that helps us. Our portfolio is clear. So when we are engaging funders and partners, we make sure, one, we are clean, our systems are clear, but two, we invest in structuring and make sure we develop bankable, robust projects. But even at implementation, we have a robust M&E system that every year we collect what we call ex-post data. Because we just don't look at the financial viability, at the robustness financial-wise, but we look at the economic impact, because that's the sole reason we structure these projects.
Yeah.
And so we have a number of indicators that we track on an annual basis that inform review, process review, and our further engagements. So I'll end it at this in the interest of time, but basically that's how we try to manage it. Thank you.
No, thank you, Francis. I think, again, a lot to unpack. And same question to Enrique. Enrique, you also mentioned the liquidity, right? I mean, your selection and down the road bankability and also the return potential. So what are you, I mean, how are you managing this issue?
Yeah, I'm totally agree with Francis that in order to make a bankable project a liquid market, we need to really, everybody needs to do the work. Right? And by everybody, also the government and the institutionality and all the rules has to be put in place so in order to bring those investors to the table. And that's a work that you need to do in the previous part that I just explained, which is the structure part of the project. Now, after we do that, it's very important to work in some of the issues that help to create more bankability. And that way, create a specific products that create that kind of approach, which is provide more bankability and more efficiency in the project, is something that we do in the process of financing the projects. So we provide a specific product like liquidity line, for example. So sometimes the government spend 6-7 months to make some payment that is obligated by them. So we provide a liquidity line that give the money to the project so the project don't have the restrictions in terms of execution. And so the government pay us these resources that we provide to the project. We have some guarantees, for example, that make more efficient the research accounts for the project financing approach. And another thing that is very important is on the private part. We help usually small projects, which is another restriction that we sometimes have, which is the size of the project, especially in renewable. So we help to go through all the process from small projects to aggregation model, so we can bring big players to the table and provide financing like capital markets or long-term financing for commercial banks or things like that. So that part, we have a team internally that help this small project to aggregate those models, create vehicles that create this a way to make this project more attractive to commercial banks or even to development banks that work only in a specific size of projects. So that's very important, for example, to provide energy or replace diesel to small towns in the Amazon, or create individual solutions in areas that doesn't have energy. We have like 300,000 households that doesn't have energy. So in order to bring those investors and make those investments, at the beginning, we create some vehicles that investors can bring investment to the table, create the size so we can create all the type of investors and they can access to capital market and make this asset class bankable for those type of financial institution, but also private investors. So this is another important role that we play, and also create like a subordinated debt to make capture some of the revenue for interruptible energy, for example, in wind and things like that. So they can bring more efficient banks in terms of cost to the table. And also we need to be very active in the concessional markets, so we can provide appropriate resources at the beginning of the project, so the project can execute the project, especially in the sustainable sector, renewables, things like that. Those are in general the main approach that we made in order to make this market bankable and be sure that the projects has the circle of life with the appropriate actors in the table. No?
No, thank you, Enrique. I think a lot of good suggestions and points and I think I just want to actually circle back to Rosemary, because I think Rosemary sits at the kind of an overview from ADB and Rosemary, you've seen the variety of, I mean, you see different income levels, different development of capital markets, domestic markets of countries. So how instrumental are some of the things which you've heard from the speakers from the 3 different countries is to ADB? You know, how do you really cater to different instruments and different levels of development of the financial market?
Sure. So let me just first address the issue or the question on how do we cater to different maturity levels, basically, of the market. Now, I think one of the speakers mentioned it is very critical for project preparation to be done in a robust and suitable manner. So when the first thing that we need to do is look at the enabling environment. Do they have, for example, PPP laws or investment laws that would have the appropriate safeguards that will attract foreign capital, or not just foreign capital, but private capital? So that's one. Secondly, we look at so before we provide a tailor-fitted solution in terms of what specific instruments go into or we will be offering, we first look at the maturity of the capital markets within the country, whether it's investment grade. We have varying levels of maturity of the capital markets across our developing member countries, spanning Central West Asia through to the Pacific, East Asia, and Southeast Asia. We also look at the robustness of the legal framework. Are there sufficient or is the law or the legal framework sufficient to attract private capital? And then we then design tailor-fit solutions. So, for example, when you look at projects which require our intervention, for example, this is in the Philippines, for example, where it is an investment grade country, we still need this will require some concessional financing, for example, from ADBs only specific to the rail infrastructure. So what we do is we blend financing. We also structure our products around the needs of our developing member countries. Now, in certain countries where you need a backstop from government, we also provide some guarantee products. So the development of specific products really are catered or are tailored towards what is needed for a particular project in a particular jurisdiction. So there's no one size fits all. We do have certain products, but we tailor fit these products and structure around it our interventions. Thank you.
Thank you, Rosemary. So I want to bring Akif, and after that, I think we'll just do a very closing remarks from all the panelists. So over to you, Akif. You know, what are you seeing? You mentioned a lot of the actually recent interest from a lot of development banks. Akif, are you still with us?
Yeah, I'm still with you.
Okay, all right. Yeah, so could you share what are you seeing in terms of the discussion points which the previous speakers have presented, and from the African continent, and how other countries who have not developed such a mechanism in terms of domestic development bank, what can they do?
Yeah, so when it comes to domestic development banks, not all domestic development banks are made equal. Some in Africa just happen to be more sophisticated than others. There are other mechanisms that governments have to deploy concessional capital to construct PPPs that are outside the development bank platform. So, for example, Rosemary, you might be familiar with this, but in Indonesia, you have SDG Indonesia 1 that is separate from the PTSMI development bank structure. As I mentioned earlier, the Ghana Infrastructure Investment Fund is separate from the Ghana Development Bank structure. So not all concessional capital, not all de-risking tools and policy and instruments have to go through development banks. That's number one. And that's what we've seen. And so it depends on, from government to government. And the second thing that I was reflecting upon based on Francis's conversation earlier about, off-take risk and intermediary off-take risk. And I think this is also where a role for blended finance can play, is oftentimes we've seen blending come into play a role to credit enhance the intermediary off-taker such that you reduce the cost of capital or the cost of financing for that specific transaction because you are using guarantees or you are using some sort of blending to reduce the probability of default because of the lack of creditworthiness of the intermediary off-taker, specifically when it comes to dealing with utilities here on the continent. So those are some reflections. We've also seen some organizations morph from credit off-takers, intermediary off-takers into being power traders in the Southern Africa power pool, on the Eastern Africa power pool. So that's one way in which you can be an off-taker, but also make some revenues because you have to pay the bills. So there's a few different models that came to mind when Francis was speaking.
Thank you, Akif. Ziad, I know you want to add something, and I think with that, we'll just, I don't know if any closing remarks from any of the panelists, and then we are at the end of the session. Ziad? You're muted.
Sorry about that. I wanted, before we start closing, to address some issues. I mean, today was great. We talked a lot about project preparation. We talked about viability gap funding, intervention. We talked about NDBs in general, but NDB's role, I think, goes way beyond these elements. And we tend to forget that. I mean, as practitioners of PPPs, we tend to forget that they are not necessarily just coming in as part of the big financing of a project. They can be, plugging certain holes in the big picture. They can be providing performance bonds for, local companies. They can construction completion bonds. So let me take construction, for example, the construction phase by itself. They can provide completion guarantees, which the local companies may have difficulty finding from commercial banks or from MDBs or from other places. They can take on first loss positions in the structures. They can They can have mini perms for, especially if there's some type of land development, urban development, anything housing that is going to be generating a certain revenue. And certainly housing, NDBs typically know a lot about housing, especially if they're housing development banks. So, to take a normal housing loans and mortgages and put it in the context of a PPP for a project, for a housing project, like for certain social housing or whatever, bring in the local development bank instead of bringing in, trying to bring in some foreign entity. The takeout financing. I mean, many projects in emerging markets have the problem of, not having long-term financing. So they may get some financing, let's say for the construction stage, and maybe after that it's on a rolling basis. So who is going to provide the guarantee for the takeout financing without putting up any funds? I mean, the national development banks can come in and do that. That's related to refinancing in a way. So refinancing role. They can have a role in guarantees. We talked about guarantees, but some places it's not just guarantees towards banks. It can be guarantees on bonds, so that enabling these projects to access capital markets in the countries which they may not be able to access without that. Protecting against foreign exchange risk, protecting against interest rate risk. So these again are parts of guarantees, but I'm trying to say that when we say guarantees, it sounds like a big thing guaranteeing the project, but it can really be very specific about guaranteeing something. Also, national development banks can play a very important role in permitting. Also something we forget about. We think that it is the PPP unit or the National Investment Promotion Agency or that can help with permitting. But national development banks are part of government, and they can play a very important role in getting things done. Their role in promoting SMEs, so especially for small-scale PPPs, it is very difficult for SMEs sometimes to participate in PPP, mainly because they don't have access to financing. Local banks may be reluctant to finance a small company, even though the project is small, but just because the company is also small, they're reluctant to finance a small company. And this is where a program, this would not be necessarily on a case-by-case basis, but the National Development Bank can have a program for supporting small-scale PPPs for national SMEs. And experience tells us that the small companies in our countries, when they participate in PPP projects, they start growing because now they have revenues, they're involved in other things, they're gaining experience. You should just have to look at the Turkish companies, for example. Look at the Turkish construction companies that started out as small contractors, and now they've gone outside the borders of Turkey and they've become global construction companies. So I just want to, I was worried that we don't touch on these elements before we close.
No, thank you, Ziad. I think those are great points. So I will just go around 1 minute each from the panelists for closing remarks. Let's start with Kishore, then Enrique, Francis, Rosemary, Akif.
Yeah, thank you, Jyoti. Firstly, PPP, then of course NDB. PPP is the main topic for us. India, as we said, 1.4 trillion implemented, 300 under implementation now. Some of the projects in energy sector, seaports, airports, metro rail, which would not have been possible at all in the history, have come only because of PPP. And for that, the viability gap funding has played a very important role. It implies that blended finance will play a much greater role even in the days to come, and will ensure the balance infra schedule, what could not be implemented with a delay, will be implemented at the earliest with expedited schedule.
Thank you.
Thank you, Kishore. Over next, whoever wants to speak, actually.
Okay, just to quick remarks on the presentation. Was very interesting, by the way. I think for us, we has been kind of successful or very successful in the last year for the roads that the program that we put in place. We can say that we have a record in liquidity and things like that I said before. But one of the main challenges that we have ahead is how can we create or replicate this model and create an asset class in the sustainable projects, which is how we can put like a green port, for example, how we can move this approach of project financing to small projects, like I said before, small scale projects to towns in the Amazon or individual solutions. One of the things that we are finding the path, and we are working still on that, is through blended finance, through bringing small investors, impact funds to those type of projects, create an aggregation models, put the size that we need to have in order to create the big investors. And that's, I think, is our next step on trying to create this liquid market that we said before in sustainable projects. And I see that there is a good opportunity to create those blended finance structure to find this gap from small project to a big project that is more common in renewable sector than in other sector that we worked before.
Thank you, Enrique. Francis?
Thank you. Very interesting discussion. I will just pick up from Ziad's remarks. I like them. The role of national development banks can go beyond what we've just discussed here. He's talked about the role of national development banks in funding SMEs. And then it reminded me of we have a guarantee scheme. We are partnering with other DFIs, and on this we work with Africa Guarantee Fund to ease access to funding from SMEs. And it has really worked, youth and women-owned businesses. We have what we call a local contractors program. And this was after realization that for these mega projects, our local firms would not participate for a number of reasons. Of course, their level of capitalization, level of preparedness, and we decided to run with what we call a local contractors program, in which we support local contractors, again, to help them grow and be competitive. But what we realize and learn in all this is partnerships, because you realize for each example I give is we are working with this MDB. And so I strongly believe that national development banks can be that bridge. Yes, you're helping to implement government programs, but you can be that bridge through which multilateral development banks, regional development banks, and other partners can really channel resources to the key development actors. That gap has always been there, mainly because the orientation, they cannot channel this money through, for example, commercial banks, because the orientation, the objective is different. And so you realize that NDBs, national development banks, are strongly aligned to multilateral development banks. If it is in green financing space and climate financing, what GCF wants to implement is basically what UDBs is running with locally. So it's just need to enhance that preparedness. There remains a gap in especially in developing countries and Africa specifically, raising money through capital markets. That remains a big challenge. And then, of course, local currency mobilization. Thank you.
Thank you. All right. I think I will skip Rosemary and Akif, if you don't mind. I think we are at the closing point, and unfortunately, we cannot take any more questions because we do have to close on time as our record for WAP. And so last, really, to Ziad, and please show your appreciation for this great panel by using the emoji or putting your comments on the chat. Thank you so much. Ziad?
I'll show my appreciation by clapping. Thank you very much. Well done. Really look forward for everyone to be staying in touch with us at WAP. Do become a member if you can. We'd love to hear from you. Thank you.
Thank you.
Thank you, everyone. Excellent session. Bye.
Bye.
Thank you, Jyoti, for your excellent moderation. as
All
always.
right.
Thank you. Thank you
Thank
very
you.
much.
Thank you, everybody.
Bye.